Well, it's time to talk about a rather contrarian theme on the panel tonight. I think we're almost at peak pessimism when it comes to the South African markets. If you look at it, foreigners were net sellers of South African stocks and bonds to the tune of almost 36 billion rand just in August. So that brings the outflows of the last 4 months to 107 billion rand, and it's not good news at all. We had a brief net foreign purchase in the wake of Ramaphosa, but that has quickly evaporated and even worsened since May of this year. In fact, since September of 2013, that's 4 months after President Zuma commenced his second term in office, foreigners have pulled a staggering 375 billion rand out of South Africa in a steady one-way outflow. So to say the mood isn't great probably is the understatement of the century. And all of these figures are pulled from a fantastic article published by Dwayne van Vuren in ShareNet today. We're in a 5-year participation bear market period. And only when we see more shares start going up than are going down, when foreigners start buying our shares and bonds again, or when earnings and dividend profiles of JSE-listed companies start improving, can we safely say that we're out of this. So the big question is, when will that happen? It's very difficult to say when that will, and I'm not saying I know when that will happen, but the question tonight that I'm putting to the panel is, where would you want to be when that happens? So we've invited our 3 analysts to share their SA recovery story stocks with us tonight. I've got Andrew Vincent, portfolio manager at Klukas Grey Asset Management, here in studio. Andrew, so good to see you again.
Thanks very much, Michael. Thanks.
On the line, hopefully we've got Dr. Adrian Saville, CEO of Cannon Asset Managers. Adrian, are you there?
You've got me here, Michael.
Fantastic. And Nadir Torkin, portfolio manager at 274 Investment Managers. Nadir, always a pleasure.
Michael, always good to be with you.
So kick us off, Nadir. Shoprite is your first pick. It missed for the first time in a long time at its most recent results, and we've seen Pick n Pay on the up, on the ascendancy. But you're still backing what is widely regarded as the best management team in that retail business. What do you like about Shoprite?
Yeah, Michael, I mean, to put a more exact time frame on your miss in a very long time, first miss in 20 years, or rather first profit decline in 20 years for Shoprite. The last time they reported a decline in profitability was in 1998, exactly 20 years ago. And that was, in fact, the exact year where they bought OK Bazaars for 1 rand from SAB Miller. So read into that what you will. But, you know, it seems that when pessimism is at its maximum, that's really when opportunity does seem to be knocking at the door, and for the brave to basically sweep up and wait out and be patient in buying quality businesses and waiting for the return. So, you know, if you think about Shoprite, they are the quintessential quality business. You know, yes, they reported a decline in headline earnings per share by just under 4% for the period. That really took the market by surprise, and the share was absolutely hammered on the back of that news. But if you look at the fundamentals of the business, Michael, you know, I think the fact that they've been world-class in terms of getting goods to their shelves, the cheapest amongst all the retailers, means that, you know, they can have the cheapest prices yet still maintain a fairly decent margin and compound capital at a fairly decent clip, given the kind of investment that they've made into their distribution facilities over the course of a very long time, well ahead of their peers, say Woolworths and Pick n Pay, or even Massmart, which was significantly lagging in that on that side over the course of the last 2 decades or so, and really only starting to play catch up with them now. Michael, if you look at how the stock has performed from its peak earlier this year, it peaked at around about 270 bucks a share. Currently trades at around about 190 rand a share. So that's about a 30% decline in the share price in a business which has been phenomenal quality. If you analyze their results further, Michael, and in fact, you know, I've seen a couple of facts from the results presentation that they delivered. It was the perfect storm for them. You know, we saw the first VAT increase in 25 years at the budget speech this year. We saw, in fact, 468 armed robberies of their stores over the course of the last 12 months. At the same time, we saw a collapse in the Angolan currency, which impacted their non-South African businesses. And they're obviously dealing with a very anemic South African economy. And just to put the cherry on top of the bad news cake, you know, they experienced the greatest amount of product deflation that they've ever experienced. And in fact, in 11 of the 12 months of the reporting period to the end of June, they witnessed product deflation, given the kind of food deflation that we've seen because of the breaking of the drought and the alleviation of that. So, Michael, this all conspired to really weigh down on their revenue growth. It really weighed down on their profitability growth. And as a result of that, perhaps the decline in profitability was a shock to the market. But ultimately, at its core, still a very, very high-quality company. And the fact that the share price is off 30% from its highs this year means that it's by no means in very cheap territory, but at the same time trading significantly cheaper than it has historically at about 19 times earnings. And that's come down from about a peak of 22, 23 times earnings earlier this year. So, Michael, I think you're getting a really good quality business here, and it's at a fair valuation. And, just one last fact to throw into the mix is they still continue to grow their market share over the course of the last 12 months, despite the very tough trading conditions. So a market share of 31.7%, just under 32% of the food retail market. So as the SA economy turns around, they are really get an increase in consumer spending, given that market share, given the high quality nature of the business and the operational leverage because of the investing in the distribution channels.
Right.
So all in all, just a good story, and the trading cheaper than it was.
I'll come back to one issue in a little while, and that's the margins, because if you look at it, ShopRite and Woolies have the second and third highest margins globally across food retailers, so we could see some pressure there. But Andrew, your first pick is Massmart, which was rather unkindly, well, maybe it was just the headline in the FM. Tim Cohen wrote quite an interesting profile of Massmart in last week's FM, where he questioned whether Massmart has lost its game. A nice little play on words there. What do you like about Massmart?
Yeah, so I mean, I think just to can I go back one step to your opening gambit of money flow and foreigners' negativity and the fact that this economy may recover. And I'm not going to go through the economic stuff, but ultimately fundamentals win out, and you can't second guess where any investor is going to put their money or pull their money. And I think that's quite an important point. So we kind of trying to hanker back to valuations and earnings prospects. And I guess it's in the context of that something like a Massmart does for us screen quite well, screen increasingly well. This thing was 170 Rand in the first quarter of this year. It's come all the way back to around 100 Rand.
Yeah,
so it's fallen back quite dramatically. It was a big beneficiary of the euphoria post the election. And I think, I mean, it's fair to say it's not a business that's firing on all cylinders. It came out of the trading update recently where things are difficult, just like Nadia mentioned on ShopRite. It's a difficult economy right now. But what we find interesting about this particular share is the operational leverage it has to any recovery in this economy. And as a way of an example, in the expectations that we've got for December 2018, which is a couple of months away now, 54% of the revenue is made up of what they call mass cash and Game, effectively the one that was in the Financial Mail. But those two businesses make up more than half of the revenue, yet they make up only 14% of operating profit. So these businesses are running on paper-thin margins, and it doesn't take much in the way of revenue increases. I mean, it's effectively 50 billion Rand of revenue that's generating almost insignificant amounts of profits for a business that size. So we think those are interesting. They've got two core businesses, being Mass Warehouse, which is macro, and the Builders Warehouse. Those are best of breed businesses. They've been dominant. They've carried this group over the last number of years. Their profit delivery has been exceptional, and those are businesses that we think are highly rated operations. What I find interesting is looking at the market expectations for earnings for 2019. So forget 2018. 2018 has been a horror show for all consumer-facing companies and financial companies, as we all know. But 2019, 3 months ago, the earnings expectation for 2019 for this business was 9 Rand a share. And in the space of 3 months, analysts have pulled that all the way back down to 7.30 Rand. And that just shows the sensitivity. It's a 19% decrease in the expectations of earnings. And that shows the sensitivity this business has. So even at 7.30 Rand on a 100 Rand share price, you're buying a business that we think is of the highest quality at a multiple of 14 times. And this business historically has not traded at these type of levels. So were the previous estimates to be right? you're buying effectively this business on an 11 time. So we think there's a story. We look for businesses that have the potential for re-rating, the potential for earnings. If this economy gets better, we think this is one of the ones that is most geared, and you've got rating on your side.
Yeah, absolutely. And back to my earlier caveat about those big ifs, we're not saying when or where, but if Adrian, Telkom, if Telkom and MTN merge, there are a whole lot of ifs around Telkom. You've gone with Telkom as your first stock, and we've had some good news on the spectrum front at least. So some positive sentiment around telcos, which are, let's face it, being battered by a whole lot of political headwinds at the moment.
Yeah, I think that's spot on, Michael. My thesis behind picking Telkom as one of the three stocks that I've chosen for this panel discussion is that the South African economy is unlikely to spring to life anytime soon. And given that, I'm looking for businesses that are resilient and that not just sort of walk through tough economic yards, but can actually find some buoyancy in a fairly dull economy. And although Telkom's revenue is unlikely to enjoy any of that buoyancy, its valuation shows a huge disconnect between what's installed and what's in the ground and what you're actually getting versus the market cap. The multiples are extremely undemanding. So you've got a business of reasonable size. It's a 30 billion rand business. Revenue growth is sluggish, not just in the recent past, but for a number of years now. So I'm not pricing this for growth. But I think the installed business is missing in that valuation. And an easy way to look at that is to reverse out the fiber business. And the fiber business is the sexy part of the business. That's where your data in a pipe come from. And you are likely to get good growth from there. Incidentally, Telkom's got about 150,000 kilometers of installed fiber. Oof. The next nearest is 15,000. So Telkom is 10 times the nearest in terms of installed fiber. Their margins are very, very stable, so steady through the cycle, 25% margins. It is a fairly heavy balance sheet, so as a result, you don't see glamorous return on equity or return on asset. But you're paying a single-digit price earnings multiple, and you're getting a 7 or 8 dividend yield, which for tough economic conditions, I think this has got resilience. It's got some attractive components, and the parts that people don't like, you're actually not paying for. So it's sort of one of those, but wait, there's more moments on the JSE.
Almost sounds like a bit of a NASPAS there as well. Interesting to see the reaction that one has received since the decision was announced to unbundle the media rump, which, let's face it, yes, is facing its own headwinds from streaming and the like, but it's still a very solid business that isn't losing subscribers, as many people had initially speculated, but is becoming something of a utility play. I don't want to digress too much. Nadia, AECI is one that is growing into Africa. The Much Asphalt transaction was an interesting one, and I think one you've chosen before. So you really like AECI. What do you like about the direction that this business is going in?
Yeah, look, I mean, so Michael, I think there's a couple of things here. I think first and foremost, let's get pricing out the way. So the company trades at around about 10.5 times forward earnings. So that's a very, very undemanding multiple. And, some market constituents argue that it trades on that undemanding multiple because it's a highly cyclical business and it's exposed to the mining industry, particularly, through its explosives business. And given the cyclicality of that industry and given the depressed nature of that industry for a number of years now, and given the fact that, they have operating margins somewhere in the region of sort of 5.5%, the lowly rating is deserved. I'd argue that, that's not the entire argument. I'd say that The explosives business is becoming increasingly a smaller part of the overall business. It's now about 60% of total earnings, and the specialty chemicals division now makes up about 40% of earnings. Now, the specialty chemicals division is a much, much higher quality business. Since its inception or since listing on the JSE, the specialty chemicals division within ACI has only recorded 2 years of negative profitability. One of them was during the global financial crisis. So a business that has incredibly stable margins, much higher quality business. They've made some strategic acquisitions there. Shurim Chemicals, they bought from Imperial out of Germany, and that's a great bolt-on business for expansion into Europe, and basically just a bolt-on acquisition to what they already do here. So the integration of the business will be much smoother. And then, as you mentioned, much asphalt. In the tar industry, really trying to play on the infrastructure spend, which is going to be happening hopefully in South Africa and through the rest of Africa. Some plan 300 billion rand of infrastructure expenditure, and they're hoping to capture some of that market share. Although that's probably a slightly bigger leap, given that they haven't played in the tar business before. Although it is an offspring of some of the specialty chemicals that they do produce. So, Michael, I think a very underappreciated business with improving quality. And I think the second point to note is that we saw a draft of the mining charter coming out today, bringing a lot more certainty. And, once investment returns to the mining sector, there's a lot of cyclical upswing for that explosives business. Again, the big if the investment comes back, a lot of upside in that explosives business. But in the meantime, you're not paying for that. They're around about 10 times forward earnings. So just an attractive business that I think is underappreciated in terms of the changing dynamic of the business and moving up the quality spectrum, and really being invited to tenders really in the explosives business outside of South Africa. So I think one of the other underappreciated facts of this business is that they're actually fairly well rand hedged, with about 35% of the earnings coming from outside of South Africa. And that proportion is starting to grow more and more into Southeast Asia and Australia in particular in the mining sector. So just an underappreciated business that's not trading on a demanding multiple and is very geared towards a cyclical upswing in the South African mining industry.
That's definitely a common theme amongst the SA Inc. stocks at the moment, is you are getting them at very good multiples at the moment. Andrew, what's your second pick? Are you going to go with a sector theme? I know bank results have been characterized by their lowest credit loss ratios in over a decade.
I think that is I think the whole financial sector, there's a multitude of options, we think, that are just looking at to your earlier point, very attractive multiples. Bank impairments have been low, and I guess that's a function of credit extension being negative in real terms for the last 7 years. So consumer credit levels have been growing at below inflation, and income levels have been growing at above inflation. So I guess by virtue of the fact there's been no credit in the economy means that impairment levels have been low. So any of the banks look attractive. We happen to think ABSA is extremely attractively valued. But if I can quickly touch on Old Mutual, because it's may have been a well-beaten drum, and if it is, we can discuss one of the other life companies. I think these life companies look very attractive. And Old Mutual is an interesting case in point, given that you're about to receive your Nedbank shares, which will be unbundled to you in the next week or two. They announced it yesterday. But Old Mutual currently trades at a price of around 30 Rand, of which Nedbank makes up 9 Rand. So you're effectively buying Old Mutual today at 21 Rand, and you'll get your Nedbank shares, which Nedbank trades at a multiple as attractive as ABSA. So it's not a tier 1 bank like First Rand, but it's attractively priced bank like ABSA. So we can have a separate debate around that. But effectively, you're paying 21 Rand for Old Mutual today. The embedded value of Old Mutual, excluding Nedbank, is about 25 Rand today. We expect that embedded value to grow at about 14 or 15%. It's a great life company. It's got the market dominance in what they call mass foundations, group schemes, personal finance. Effectively, if you simplify the investment case of Old Mutual, so we think the embedded value of Old Mutual will be 30 Rand in 12 to 18 months' time, and you're effectively buying that business now for 20 Rand. So we think you are currently getting a business the quality of Sanlam, which trades at a healthy premium to embedded value in the order of 20%. You're buying a business of the quality of Sanlam for the rating of an MMI or a Liberty. And therein, we think, lies the potential to unlock significant amounts of value.
Very attractive.
If this were to trade at a parity to embedded value, you're already getting 50% upside over the next 12 to 18 months. And if you don't like embedded values, which is academically a very pure way of valuing any business, because it's a discounted cash flow of all future profits, you could use an earnings base, and we think the expectation is that they'll earn nearly 3 Rand a share in 2019, and you're effectively paying 21 Rand for that. So, any way you slice and dice it, it looks like a very interesting investment opportunity.
And their decision now to go into banking as well, because they're offloading or unbundling that Nedbank stake, is quite interesting from a strategic perspective. As you said, that mass foundation market, they flood the market with their funeral policies.
They're very dominant in that space. Their market presence is extraordinary, and
extremely dominant.
Their business, their ability to leverage corporate relationships and shop floor. Their presence is extreme. So.
The big green going big in your books. The second pick, Adrian, that you've pulled out of your bag is Storage, which is a property REIT. It raised 400 million recently, and it's the only self-storage company listed on the JSE, and it pulled off quite an oversubscribed book build, so clearly the market likes Storage. What do you like about it?
Well, I think, to borrow from Nadir's point, this is, I love his term, it's an underappreciated stock. And perhaps not only is it underappreciated, it's in a sector that has been become unloved. For a long time, property has been a darling of South African investors. And certainly if you look at, the 10-year returns from property, they're very good. But if you take just the South African property component listed on the local market, I think it's interesting that over the past 5 years that index runs flat. So to me, that's a clear indicator that the sector is unloved. And if we can find an underappreciated stock in an unloved sector, you might be offered some really good prices. I think that's in part what you're getting in Storage. It, as you note, it's a fairly unique proposition in that it gives you access to a very large portfolio of self-storage properties. It has about 300,000 square meters of gross lettable area across 43 properties. But across those 300,000 squares and 43 properties, I think the really interesting component is there's more than 18,000 tenants. And that gives you an incredibly granular client base of that lettable area. So it's not a business that's going to have shock firings or large vacancies, given the granularity of the tenants. And you're buying this at a modest premium to net asset value. So the net asset value is 11 Rand 60. I think that's one of the sort of key metrics you want to look at in valuing any property is what's the bricks and mortar. So you're paying 12 Rand 50 for 11 Rand 50 of bricks and mortar. Return on equity is 16%. You've got this granular portfolio. It's very ungeared. Debt to equity is just 23%. And you're being paid an 8 dividend yield that we expect to grow by about 10%, given the very high renewal rates and the high stickiness of the tenants across these various portfolios. They've also ventured offshore in a modest way, and I think that offers some diversification. But if you're looking for a well-run business, great underlying asset, good growth prospect despite the sluggish economy, I think Storage is a great candidate.
Adrian, I'm unfortunately trying to get Bernard Swanepoel on the line now as well, and trying to juggle whether or not we can get through to our last picks, and I think we can. So I'm going to ask you to jump straight through to your last pick and give it to us in under a minute, because we are struggling to get Bernard to talk about the mining charter. There's been a lot of confusion around when it was going to be published, when it wasn't. What was your last pick? I didn't actually see that.
My last pick is clientele, and here I'm going to borrow a little bit from Nadia and from Andrew, because if you're looking for a business that's been able to grow earnings without interruption for more than 15 years, clientele is your candidate. They have a superb earnings track record. Andrew speaks about embedded value for looking at an insurer. The embedded value grows steadily year on year, given the growing client base. They're giving you a dividend yield of 6.5%. You are paying up modestly for those earnings on a 13 price earnings multiple, but you've got a steady grower that has a fantastic track record, a highly regarded management team, and you're being paid a 6 dividend yield to own this business. So I would put alongside Old Mutual, which at Canon we agree, Old Mutual is a fantastic asset in this environment. If you've got the appetite to look for a slightly smaller business to join the big green, you could complement that with clientele as a superb insurance business.
And then finally, Nadia, you've gone with Italtile, which has been something of a self-help turnaround story in and of itself. Italtile, what are the key numbers here? If we look at the most recent results, a nice uptick in top line, in profit, in net cash, in dividends, everything pointing in the right direction.
Yeah, 100%. And this is in a very difficult economy, Michael. So we note that the consumer is under severe duress, and you'll notice it in, as we've alluded to in the show, a number of the retailers reporting declines in profitability. Italtile growing their headline earnings per share by 15%, declaring a special, increasing their dividend by 27%, and over and above that, declaring a special dividend. So generating mountains of cash. And I think a very high quality business that generates returns in excess of 20% has very little competition in South Africa, and realizes the fact that they're not going to be getting a lot of growth from the mid-market space, particularly which is CTM, which is the business that they operate over there. And to counteract for that lack of growth, they've started vertically integrating. So recently purchased Ceramic Industries, which is one of the last tire manufacturers left in South Africa. So they're now vertically integrated. That's going to be margin accretive. It's going to eke out more cash over the long term. And all of this now with a business that's, again, trading at not very demanding multiples at around about 13 times forward earnings, and we think that, or 14 times forward earnings, and we think that that's not very demanding, given the quality nature of this business, given how astute management has been with deploying capital, and given how much they've invested for growth, opening new stores, so continuing to invest for growth.
Lastly, Andrew, what do you have in your bag of tricks?
So I found the smallest company I've ever seen on the JSE. If I may talk about it for a second. It's called PrimeServe. We're running out of time, but I encourage anyone who's listening just to go and dig around and scratch around. PrimeServe is a business in the recruitment space, recruitment and training. It's I suppose it's a mini AdCorp in some ways, maybe not of the same quality, but it's got a neat little niche.
I thought the tide had turned against those so-called labour brokers because of the regulations.
This is the opportunity, I think. But time will tell. History's the perfect judge. But we think what this business last year it earned 17 cents, and now to June 2018 it earned 21 cents. It trades on a share price of 51 cents. So it puts it on a 2.5 PE, and you don't come across those too often.
One of the smallest companies with one of the quickest reviews I've ever heard on.
But I can go
business.
into more detail.
No, unfortunately we don't have time. Thank you very much, Andrew Vincent of Klukas Grey Asset Management. It's joined by Nadia Tolkien, Portfolio Manager at 27/4 Investment Managers, and Dr. Adrian Saville, CEO of Canon.